All right, welcome back to the next Beyond the Skills podcast, where we talk everything business, entrepreneurship, real estate, marriage, drugs, sex, alcohol, you name it, whatever you into. But today I got a special guest for you guys. He is somebody that I've been wanting to get on my podcast for a while. I've been secretly watching him because I like your stuff on social media.
Appreciate it, thank you.
So give us the 50,000 foot view. You're gonna have a lot of people watching from YouTube, all over the country. Give them a 50,000 foot view of who you are, what you do, and then we'll get into some actual compliance stuff to help these guys.
Yeah. So I'm a securities attorney. I'm an SEC securities attorney, which means my job is to make sure that capital raisers raise capital compliantly, right? We've got to follow the rules. When you're out there raising money, most of the time you're selling securities, and so my job is to make sure you're doing that correctly. I've been doing this for 25 years, as you can tell from my white hair. Started a law firm back in 2006, exited that firm last year, started a new firm, and so I still do a lot of funds and a lot of syndications, and I also do now a little teaching and some mentorship. So I got an inner circle that I run, and again, just always trying to add value and helping capital raisers stay out of jail, because that's my main job.
And you've helped some of the biggest names in real estate raise capital. Robert Kiyosaki, Ken McElroy, which I love Ken McElroy.
Yeah.
He's a quintessential operator. You ain't gonna get a better operator than him. Brandon Turner, some of those names.
Yeah. Now, Robert doesn't raise capital himself, but it's interesting because I got into this world thanks to Robert. I read the, Rich Dad, Poor Dad, like probably most people. Then I heard a radio ad from Robert just kind of pumping the real estate guys, who's another big group. And so I became their general counsel. Thanks to that book, led me to Robert Kiyosaki, who led me to the real estate guys. By the way, led me to my wife, who I'm now married to. But also that got me to the real estate guys, which is really where I cut my teeth on the syndications. Started a law firm from that, kept them as a client, obviously, and then 17 years later, built it to multi-seven figures and exited last year.
That's awesome. Let's talk about, because we're talking about this off camera. There's a lot of people going to jail. There's a lot of people on that Baller Busters Instagram.
I haven't seen that. I got to check it out.
Yeah, but that are just, man, they're getting hammered because they're getting arrested for, frankly speaking, raising money illegally.
Yeah.
Because you said there's a few different ways here. You got syndication, you got joint ventures, you got funds.
Yeah.
Why don't you break that down to my audience that's going to listen here, because they may not understand the similarities and differences of those three things. Yeah,
so the first thing you've got to really think about is when you're taking money from individuals, are you in the business of selling securities? That's the first question you have to ask that question. Like,
what's the definition of
selling?
That's
right. So my layman's definition of a security, because I'm my good friend Tom Wheelwright, who's one of the Rich Dad advisors, he likes to say I'm one of the few lawyers that actually speaks English. So my English definition of a security is anytime you take money from passive investors where the returns are generated by your efforts, meaning you're doing all the work and the investor's just writing you a check and going home, that is your definition of a security. Doesn't matter what the structure is, you can call it whatever you want. It could be LLCs, it could be profit sharing agreements, it can be tenants in common agreements, it can be high fives, handshakes. The structure doesn't matter. They're going to look straight through the structure and say, are you the one who's generating the return from that money? And if so, it's going to be a security. And so that's the first question you got to answer. And people get into trouble because they raise capital, especially smaller amounts, through promissory notes, for example, or through attempted joint ventures, right? And calling something a joint, let's talk about joint venture. Right? Calling something a joint venture in and of itself doesn't make it a joint venture, right? In order for it to be a joint venture, you essentially have to do the opposite of the definition I just gave you, right? So in order for it to be a true joint venture, the returns need to be generated by everyone's efforts. Everyone needs to be contributing to that return. And so you're not really raising capital from investors. I actually made a post today about this. You're not really raising money from investors. You're starting a business. You have business partners. You're actually aggregating capital with your business partners. You're starting a business, and then you're going out there and acquiring a piece of property or business or whatever. But everybody needs to be rolling up their sleeves and doing the work.
I want to get some clarity on this because I do a ton of joint ventures, and I want to make sure I'm not breaking law. I want to be in Baller Busters. So I do a lot of joint ventures where I'll find the deal, I'll raise the capital, I'll take 30, 40%, they'll take 30, 40%, the operations guy takes 30, 40%.
Yeah.
Now, with me, sometimes I'm checking on the deal, sometimes I'm not because it's in a different state. When you just said all three of us have to be working on a deal. If I'm raising the capital and sponsoring the loan, aren't I working on the deal?
Yeah, like if you're sponsoring the loan, that entitles you to get a little bit more of a percentage. But the questions I would ask is how much money is everybody contributing? I would start with how many people are in the joint venture.
Typically 2 to 3 people.
Right, so that's great. So usually if you keep it below 5, that's a good thing. I've seen joint ventures with like 13.
Okay.
I've seen 13 people in a joint venture. That's not going to work. Right, just like when you're doing a syndication and you have like 13 co-GPs, general partner, that's also an issue. But the SEC says that once you get to about 5, it's hard to argue once you have more than 5 that everyone's actually actively involved. There's somebody there that's just really contributing the capital. So does that mean it can't be 6? It can be 6, but the more you go, I think the harder it is, or the more you've got to really show that you are all actively, the more pressure to do it. So 2 or 3 is great, right? So the next question becomes like, who's running the show, right? Is it a decentralized operations, or is all the control in you, right? Now, you could be running the day-to-day. I'm okay with that. But do the other partners have voting rights, for example? And can they actually exercise them? Like if they don't like the way you're operating, can they remove you? Say, there's 3 of us. Chris, I don't think you're doing a great job. We're gonna vote and we're gonna remove you as manager. Mauricio now is gonna be the manager. If they can do that, then great. That's a more decentralized management group. The more you concentrate the power into one person, the more it starts to look more like a joint venture. These are never black and white issues, by the way. These are all sliding scales, and they go from gray to black to white. Like it's just a sliding scale. But that's another question I was asking is, what's the level of control? Who controls it? What do the distributions look like, right? Like in an ideal world, everybody's contributing capital, because again, you're starting a business, and everybody's taking a percentage of the deal based on how much capital they're bringing in.
What if they're not bringing capital? They brought the deal.
Right.
One person's operations, one person's found the deal,
right.
One person is
so the concern would be who's bringing in the capital and what else are they doing? Because if they're just primarily bringing in the capital and not doing any work, that starts to look like a security. Because again, they're just giving you money and then they're sitting back and doing a little bit of work. So you want to make sure that they're actively involved, right? You want to be making sure that that's the key. You want to be actively involved in the deal. And then you're just not going to have structures that you would in a securities offering. So in a securities offering, you would have maybe preferred returns, right, to your investors, or maybe there's a carried interest, meaning you're taking a 20% sweat equity for putting the deal together. Those don't exist in a joint venture because, again, why would you be taking a piece of sweat equity when everybody's doing the sweat equity, right? So you would generally see if there's 3 or 4 people. I'm not saying everybody has to be equal. Like, some people might only be working on the weekends and not have a ton of time. So maybe they're putting in 10% of their effort, and they'll have 10% of the distributions, and maybe they put in 10% of the profits. But ideally, you want to have that match, because if one person has more or less, then I just start asking questions. Well, why? Like, why are you getting more? Oh, because I'm doing more of the work. And then it's like, okay, well, now it looks like you're now really the one that's generating the return, not the person who just wrote you a check.
But if all that's defined in the operating agreement, I would assume that you're good.
Yeah, I mean, if everything's, defined and then actually executed, like just because it's in the operating, but if you're actually following through, and because the SEC is just going to look at you and say, what exactly are you doing? They're going to ask you, like, what are you doing in this deal?
And it doesn't have to be physical labor. It could be checking on your operator and say, hey, how many vacancies do you have? How many people you kicked out? How many did you rent up? I mean, that's work.
If you're the one who's contributing the loan, for example, you could argue that's part of the capital, just because you didn't put your cash out of your pocket. If you guaranteed the loan or actually had to that would also count as capital. So you just got to be really, really careful that just because you call it a joint venture, or just because you're like, oh, it's a small deal, it's only friends and family. It's like, I'm going to do this one as a joint venture. The answer to that is you don't get to make that decision, right? It is what it is. It's either a joint venture or it's a security. You calling it one or the other doesn't make it so. Which reminds me of Rich Dad folks. Tom Wheelwright, he's very famous. He's a tax guy. He's well known for saying something to the effect of
Blonde-haired guy.
Yeah.
I've read his book.
Yeah, he's got a tax-free wealth. Yeah, tax-free wealth.
That's a great book, by the way.
He has a famous saying, if you want to change your tax, you've got to change your facts. That's what he's kind of well known for. So it's similar in the syndication where, like, if you want to make something a joint venture, and you've got to change the facts to make it a true joint venture, right? If you call me and say, hey, I'm going to do this as a joint venture, but you're the one who's in charge, you're running the show, you're basically doing all the work, and everybody else is just doing very little work on contributing the capital, then that's going to be looking like or if you have 17 people in the joint venture, it's going to look like a joint venture.
Which I want you to correct me, but for most of the guys that are just getting started, they probably should start off with a joint venture. It's probably a little bit safer than, syndicating, which I want you to get into next, syndicating. And then the next level I want you to get into is how to create a fund and what that looks like and why. Yeah. Because I've heard both ways, like funds are complicated, they're cumbersome, so is, syndication.
Yeah.
But would you say that joint venture is a little bit less cumbersome?
It's definitely, if it's structured properly, it's 100% less cumbersome. Plus, you're probably raising smaller amounts of money, right? Like if you're buying $1 million, let's call property, if you're buying $1 million asset and you're financing and getting a 70% loan, you may only need $300,000 or $400,000. The economics don't work to do a full syndication on 3-4. The compliance cost is going to kill you. You'll spend 15, 20 grand just on the lawyers and doing all the compliance. So if you're just raising 400 grand, it doesn't make sense to do a securities offering or a syndication. So joint venture makes sense, but you've got to make sure you structure it properly and make sure you're working with somebody who can mold it. That's what you're really trying to do. Make sure you're molding it so that it is a joint venture and doesn't run the risk of going on the other side.
Would you say like a $1 to $5 million deal would be safe to joint venture?
I usually say anything over $1 million. Let me just, how much are you raising? I always think about how much money
you can always raise 20, 30%.
Yeah. So if you're raising close to $1 million, that's when it starts to make sense to syndicate. The economics will work. But it really has to come down to, again, control. Like I can tell you, like we can do this as a joint venture, Chris, but you're not going to be able to have full control. You're going to have the other people involved. Well, I don't want that. Like, screw that. I don't want these guys involved. I want to be making all the decisions. I want to run the show. Well, that looks like a securities offering, right? Because you're making all the decisions. So that's the challenge I face a lot, where I'll explain to the client, hey, yes, we can do it as a joint venture, but you're going to have to do this, 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 this. And they're like, well, I don't want to do this, this, and this. I want to have control. I want them to have no voting rights. I want to give them a preferred return. Then I want them out. And that starts to look a lot like a securities offering. That's security.
Yeah. Basically, if you're the quarterback calling all the shots,
100%,
that's a security.
That's a security. Anytime you take money from passive investors where the returns are generated by your efforts, it's a security.
Okay, guys that are watching this and following this, you'll have to understand the difference, because if you want to be in complete control, you're going to violate.
It's a security. And it's tough. And I don't have a good answer for you, because it's tough. Because again, if you're trying to raise 200, 300, 400 grand, you can't go spend 10, 15 grand. No. It'll just kill your number. So I'm sympathetic to the issue. I'm just telling you what the law is. Like, it is what it is. I don't make the rules, but so that's the.
But if they're joint venturing, as long as they understand that they need the other parties need to have some kind of say so, and you can't be the main. You may have more knowledge and say, hey, we're going to do a vote. I am the most knowledgeable. I'll make the final call, but I'm going to get y'all's input.
You have to have,
that would be a way to kind of sideline that securities and getting in trouble with the SEC.
They have to have real opportunity to exercise those voting rights. They have to have voting rights, because in a syndication, we're talking about, there is no voting rights. Like the partners have no say. Like they have no voting rights. But in a joint venture, everyone has their proportional voting rights, and they have to have real opportunity to exercise those rights of calling a vote, doing the whole thing.
Well, then I would say $1 to $5 million for the whole purchase price is safe, because if you're raising $5 million, say 20% of $5 million,
it's about $1 million.
It's about $1 million. So you're safe, for you listeners, if you're maybe buying a mobile home park or doing an apartment complex that's under $5 million. I would say I'd stick to the joint venture. Now, you got the next tier of that, which is going to be
the syndication. Syndication, yeah. And again, syndication is just another vernacular for a securities offering. Really, it's just a. But most in today's world, a syndication generally refers to a single asset purchase, meaning you identify. Let's stick with the real estate. You identify a property. You get into contract for the property, and then you go raise a specific amount for that particular property. You've got a business plan for that property. You know exactly how much you're raising. You know what the exit's going to look like. You know what the splits are. You have all the details, and you put together a business plan, right? That's what a syndication is. It's really a single asset.
Now, one person's calling the shots.
One or a group of people, but yes, one person or a group of GPs, general partners, will run the whole deal. They're the sponsors. They put the deal together. They'll find the property, they'll do diligence, they'll close on it, they'll asset manage, they'll property, they'll do all the work, and investors will simply write a check, 50, 100 grand, and they're going to go home, and you're going to give them a distribution once a quarter or whatever it is.
But you have to give them, you have to get a PPM.
Yeah, so one of the things we didn't get to that, so once you understand that if you're in this world where you're selling a security now, it's no questions, you're raising a couple $1 million and you've got 15 investors and they're passive, that's a security. And so the rule is there's really three things you've got to think through once you understand that you're selling a security or doing a syndication, or a fund for that matter, is number one, you have to either register that syndication with the SEC, the Securities and Exchange Commission, which we never want to do, or you have to find an exemption to registration, or it's illegal. Those are your three options, right? You register, you find an exemption, or it's illegal. We don't like to do anything illegal. Hopefully nobody wants to do anything illegal. We don't want to register. That's going public. That's an IPO. We don't have time for that nonsense. Like, we don't have time to wait. You get in a contract, you got to close in 30, 60, 90 days. You can't wait 2 years for the SEC to approve your deal. And so you're always looking for an exemption, right? And that's when, if you've ever heard terms like a Reg D or a 506B or a 506C. Those are just exemptions that are available to you. And part of my job is to figure out what's the exemption that's appropriate for you, because each exemption will give you a path, right? So people always
to raise money?
To raise money, or what can you and cannot do. Everybody said, well, can I do this? Well, it depends on what path I've chosen to go, right? And that's why it's so important to choose the path at the beginning, because then you know, okay, I've chosen this path. This path does not allow me to go on social media and advertise my deal. It allows me other cool things, but I can't do that. Versus if I pick this path, I can advertise on social media. I got other restrictions. So knowing that ahead of time, what path you're going to take is critical, and that's the decision of what exemption are you going to rely on. And most of you are going to rely on one of two exemptions because they're by far the most popular. I think 95%, 93% of syndicators, whether it's a fund or a syndication, this applies to both, will rely on. That's the 506B exemption or the 506C exemption. It's really the same 506, but one's a B as in boy, one's a C as in Charlie. And they're both actually pretty close. They're almost identical in the sense that you can raise unlimited amount of money. Biggest one I've seen so far is Blackstone. They have a $50 billion real estate fund. It's a 506B. So unlimited amount of money, but the differences come to the advertising piece. So if you want to advertise, you got to go C, 506C. 506C
on social media
allows you to advertise and generally solicit. So if I was doing a 506C deal, I could have shown up today and started passing out business plans, advertise, generally solicit, go on social media, go on podcast. If I had a deal, I could pitch it to your audience if you allowed me to. I don't even do deals, but so 506C allows me to advertise. 506B does not. However, 506C, the good news is I can advertise. The bad news is I have to limit my investors to accredited investors only.
Oh, and so if you're going to raise money on social media and advertise, it has to be accredited.
You have to accredit its only, and you
tell
have
them.
to, yeah, I'll tell you this.
Don't know what accredited investors
Yes,
mean.
an accredited investor is really a high net worth individual, right? It's somebody who has either $1 million of net worth, excluding your primary residence, or on the income side, you've earned $200,000 a year for the last 2 years, with a reasonable expectation of earning that much this year. And if you're trying to combine that income with your spouse, that number goes up to $300,000. And then they've added some of these things over the years. Just the last update, certain licenses, if you have some, I don't know if anybody here somebody has a securities license, but if you have a Series 7, Series 82, or Series 65 securities license and you're in good standing with your state, you're also going to be accredited. And so with 506C, I'm limited to accrediteds only. So I can advertise and go on podcasts, but I've got to stick to accrediteds only. And I must take what's called reasonable steps to verify. I can't just take your word for it. I can't just ask you to check a box and be like, I'm good. I'm going to have to either, honestly, we just use third-party verifications, but if I was doing it on my own, I could look at tax returns, I could look at W-2s, I can look at, all that kind of stuff. Honestly, it's so inexpensive to get $50 gets you a verification per investor, so that's the route I would take. So 506C is cool. It's only been around since 2013. It's only been, it's been 12 years now, I guess, but when I started this, 20 some odd years ago, there was no 506C.
What is McElroy and Robert?
So Ken has always done 506B, and I've tried for the last, I've known him for a while, I would say the last 10 years to move to a C because his YouTube channel's blown up, and he finally listened to me. We finally did a 506C, I don't know, about 2 months ago. He did a huge, I think $40 million in Nevada. So that was good. But with 506B, the good news is that I can take up to 35 non-accredited investors. So you can bring in your mom and your dad and your Aunt Karen, your Uncle
35
Pete,
only.
35 non-accrediteds, but I cannot advertise. I cannot generally solicit. I cannot go on social media. I cannot go promote this thing. It's really meant for your inner circle. It's like it's meant for people that you have a pre-existing relationship already. It's not something you go advertise.
How do you do a mixture of both where you can raise money on social media from anybody? Is that
yeah, so there are a couple of options, right?
I know Cardone is doing.
So Grant Cardone's a great example. So Grant Cardone started doing 506Cs, is what I think he started with 506Cs way back when, and he had a high minimum. I think the minimum was like $250 minimum. He started doing a lot of Reg A's, which is another exemption, right? So Reg A is getting a little bit more traction, but it's still a very small sliver of people. But Reg A is really good for funds because Reg A is what we call a mini registration. So it's not a full-blown registration, but I have to get approval from the SEC, which means what? It's going to take a lot of time because I'm dealing with the government, right? So now, instead of just preparing all of my legal documents and disclosure documents, So in the 506B or 506C, I'm not asking for permission. I'm just doing it. I'm just complying with the law. I've got my disclosure documents, which we can talk about, and those are in my back pocket. And if I ever get audited, great, I can show.
But this isn't a fund. This is what you call a P.
This is called a So in a 506B or 506C or even in a fund, you are required to provide your investors. One of the things you have to do with your investors is provide them disclosure documents. You can't just go take 100 grand from someone. You have to give them a document that shows all the risks, all the ways your deal can go wrong. I don't know how many of you had surgeries before, but I've got terrible teeth. I don't know. I've just ever since I was a kid, I'm just terrible. So I've had oral surgery. I don't know how many times. And every time I go have an oral surgery, before I go under, even though I'm only going to be under for like 2 minutes, right? What do? They give you that yellow medical consent form, right? All the ways your surgery can go wrong. For me, it was like you could have some bleeding, you can get an infection, you could die from getting your wisdom teeth. And so you review the risks. You're like, cool. You sign it. Doctor signs it, and they do the. That's what a PPM is. It's just all the ways your deal can go wrong. Literally every single thing I can think of is like, how could you lose your money? I'm going to disclose that in this document so that as an investor, you go into the deal with eyes wide open. You've read all the materials. You know all the risks. We're going to tell you it's risky. I mean, I'm going to tell you it's risky. You should be able to withstand losing all your money. There's no guarantees here. And you read that, and you can then make an intelligent decision whether this is an appropriate investment for you and sign the PPM.
So all a PPM is just a disclosure.
It's all it is.
Everybody
it's a
knows what's going on.
All the skeletons in your. Have you been convicted of some crime? That's going to be a disclosure. Have you been anything that you can think of that would be relevant for an investor is going to go into this document called the Private Placement Memorandum, which is the PPM.
And this would be if you're raising over $1 million.
Again, I've done syndications for 400 grand. I mean, it just depends. Again, it's not a dollar amount. It's really the control. Like, do you want the control? The challenge is if it's just, again, there's a cost, there's a compliance cost, right? I mean, I got to put my kids through college, right? So even though I probably shouldn't. So there's and securities attorneys aren't generally that cheap, and so you're spending probably somewhere between 10 and 20 grand on a securities attorney. So if you're raising 400 grand and you put that into your use as a fund, you're underwriting, and you've got an extra $20,000 expense, it really starts eating into your returns, and it may not make sense.
But you're giving just prefs on these. You're not necessarily giving equity, whereas these, it's all equity. This is all prefs?
This is all equity. No, the investors get the vast majority of the equity. So a typical syndication it comes from the hedge fund world. It's usually an 80-20 split, where the investors put up all the money to fund the deal, and they get 80% of the equity. And you, in exchange for doing all the hard work and finding the deal and getting the financing and doing all these things and personally guaranteeing it or carve out, you get 20%, maybe 30%.
And maybe some fees.
Oh, a ton of fees. Yeah. So you'll get fees. So the private equity or the hedge fund model is this. Anybody heard the 2 and 20? Right? You've heard about the 2 and 20. They take 2% asset management fees and 20% of the profits. I think that's where it came from. And so syndicators do something very similar. They'll take an acquisition fee. So when they acquire the asset, they'll take a 2% based on the value of the property. So if you're buying $1 million property, you get a $20,000 acquisition fee at close. Then as you're running the deal, you'll probably get another 2% of an asset management fee, which is usually based on rents. So whatever you collect on rents, 2% of that. Then you're getting 20% of all the profit split. So every time there's rents coming in, right, you split it with your investors. 80% goes to the investors. You take 20% of the cash flow, the net cash flow. But the big money is at the end, right? The big money for syndicators is always a little bit on the front end. Acquisition fees usually can be a nice chunk, especially if you're raising, if you're buying a $20 million building, 2% is a nice healthy chunk. But the big money is on the back end, because when you sell and you've added all that value to the property, now you're getting 20% of the profits, and you haven't put in a dime, right? Yeah. Or you put very little money into it, and so that's where the real money gets made, is on the sale.
I want to talk to that though too, because you've seen a lot of syndicators that got greedy, and they were feeing everybody. They were just locking deals up, and I saw it. I was like, none of these deals made any sense. They were raising capital. I look at the numbers. I'm like, none of this makes any sense. But I finally figured out they were making money with all the fees.
All the fees, yeah.
So even though it wasn't a deal, it didn't really check the box off. They were hoping inflation would just keep carrying us until it didn't no more. And that's why we got a lot of people that are hurting in the multifamily space. You want to talk about that?
Yeah, multifamily definitely has been hurt in the last couple of years, but I think that's mostly because of the interest rates just went up. Here's what happened in multifamily.
Insurance too, though.
Yeah, but this is my take on the multifamily problem, is that during COVID especially, right, you had a huge run up on prices of real estate, but the rents didn't really keep up. And so it was very, very difficult for syndicators to get the leverage on a traditional loan. In the old days, you would get an 80% loan, maybe a 75, 80% loan, and because the rents weren't keeping up, your debt service coverage ratio wasn't there, so they were only able to lend you 60 or 65% instead of the 80. So they were getting squeezed on the leverage. And so what they did is they went the bridge loan route, because with the bridge loan, they were willing to extend that back to 80%. So in order to get the 80% leverage, they had to go with a bridge loan, which carries more risk. It's only a 3-year loan, right? And so they have to refinance after 3 years, right? And what happened, obviously, is the interest rates went, not only did they go higher than people thought, but the speed at which they went very high. Most people get insurance, they get rate caps, meaning you get, like for example, clients were getting rates of maybe 4% when they bought the property, and maybe you get a 6% insurance, meaning it's a floating rate interest rate, so that you have 4%, next year it's 4.5%, 5%, and you're now having to pay more of your debt service, right? Your mortgage payment keeps going up, year after year, but once it gets to 6%, you're capped, you've got insurance, so the insurance will cover whatever is above the 6%. So you knew that worst case scenario, you were paying 6% until your rate cap expires. I mean, that rate cap only kicks in for the 3 years. So after 3 years, you've got to either sell the property or you've got to refinance. But obviously property prices came down, and so when it's time to refinance, interest rates and properties came down. So when it got time to, they had to get out of it, because I'm like, I can't afford this. I can't, my interest rate would set from 4% when I bought it up to 6%, which was my cap, and now when the cap gets removed, I'm paying 9%.
Yeah.
I can't afford that loan. I don't have enough money to do it, and so I have to either sell or refinance, and the properties just weren't worth that much.
Yeah.
And that's the challenge they're having.
And insurance doubled and tripled.
In many parts of the country.
Cost of labor doubled. Cost of material doubled, and the insurance. So it was like a 4-tier whoop ass. Yeah. Right, I felt it in the mobile home space. Yeah. Thank God we bought such good margins, and we absorbed a lot of that cost. But man,
and remember the equity. The investors. If you're doing an 80-20, that means you've only got 20% of equity, so the property goes down 20%, which is kind of what happened. They, on average, 25-30% drop. So that $1 million property now is only worth $800,000. There goes the equity for all the investors. So.
Well, I spoke at a multifamily event last year in Houston, and they had a big mortgage broker that came, and he said, C-class is so underwater. All these people came and thought they were going to do these big value adds.
Right.
They're all
value
C-class.
add doesn't work anymore.
And he said, by this time, by the last quarter of this year is when the bank, because the banks keep giving them more time and kicking these loans because they don't want to face it.
That's right.
But hoping that interest rates would come down, but Jerome Powell just now say, hey, we're staying the same. We're not going nowhere. So
they were saying, I think last year the slogan was survive till 25.
Correct.
Now it's persist till 26. And who knows? They're coming up with I think somebody said what was it? Something like vulture in 27. I forget though. They're just coming up with all these rhyming things. But
dead in 27.
Yeah, it just keeps getting kicked out because you're right. The banks don't want them. So they were doing loan modifications, they were doing extensions, they were doing all this stuff, especially if they weren't in default. But these deals just aren't working out. And we need it to get cleared, because until we clear all that crap on the market, we won't be able to get into that new cycle. And so we're kind of hovering still at the bottom. We need to get all those things off the books.
So there's going to have to be some pain, blood in the streets, and there's going to probably be some opportunities where the bank's going to have to take a haircut. And there's a lot of opportunity for you guys that are watching.
100%.
I think multifamily is probably by then this year, going into next year, is going to probably be a lot of opportunities.
Yeah, that's the thing. So that's the syndication model, right? So the syndication model is you identify an asset, and then you go raise money for that specific asset. So you have a very specific business plan. And again, most of my clients, the value add, you just mentioned the value add. So people were buying it, they were putting in some CapEx, fixing it up, doing this, increasing rent, increasing occupancy, increasing the value, doing a cash out refinance. That was kind of the model. And so when interest rate went up so fast and construction went up, it all went. A fund is the other way around. So a fund is still a securities offering, but instead of finding the property and then raising the money for that specific property, you raise the money first. Then you go out looking for the property with the money you've raised. That's the key difference, right? So in a syndication, you identify property first. You know exactly how much. I need 1.35 million to go do this deal, to buy it, fix it, do whatever I need to go do, pay my fees, 1.35. Here I'm raising 5 million, 10 million, 20 million, whatever it is, a million, whatever it is, and once I have the money in the bank, then I'm going to go shopping and going to find stuff based on the criteria I gave my investors.
But you're on a timeline. if you can't find nothing, you're on the hook to paying press.
That's right. Depends on how you structure. But yeah, that's one of the fears people have is like, hey, if I could suddenly raise $10 million and I have $10 million in my bank and I can't find anything in the next 6 months, I'm just like, and I'm promising my investors a 7% preferred, and I'm like, to your point, like I'm burning through that. So that's one of the concerns.
That's exactly why I never started a fund.
Yeah.
Because I raised a lot of money, and that was my worry.
Yeah.
I can go raise $5-10 million bucks,
Yeah.
and then what if I can't place it?
Yeah.
And I got to write a check out of my own pocket.
Yeah, there's ways to mitigate that for sure. In the old days, like in 2021, 2022, when interest rates were like zero, right? You couldn't put anything back. What we were doing, we still primarily do this, is if you go raise 10 million or whatever the number is, you don't have to take it all up front. Right? So you can take, I like to take like 10% of whatever. So if somebody commits $100,000 to your fund, maybe they only give you 10 grand for now. And then when you find the deal, that's when you ask and you cash call the other 90. And if for whatever reason they decide to go, screw this, I'm going to go somewhere else, they'll just forfeit that 10 grand. So that'll protect you a little bit.
And I can't buy a Lambo and just say, hey, I'll pay you later once I find a deal.
That's the fastest way to be on the what's the thing called? Baller Bus. It's the fastest way to get to Baller Buses if you're using that money for
personal.
For personal gains.
Yeah. Which has happened a lot.
Oh yeah, it's happened a lot. Usually, I wrote a book called "The 5 Things Every Syndicator Must Know to Stay Out of Jail." It's a good title, but the reality is, if you're doing that, if you're buying Lambos with the investors' money, or you're, some people are even like taking money from one project and to bail the other project out. When you start doing that kind of stuff, that's where your fraudulent stuff comes in. For most of the syndicates, just so we don't scare everybody away, for most people who just are doing it and maybe they do something non-compliant, the remedy really is what we call rescission, which means you have an obligation to return all of your investors' money back, plus interest, plus penalties. You'll probably get a slap on the wrist too, in terms of maybe you're not allowed to raise money for a couple of years or whatever. But rescission is the main thing. Now, can you go to jail for sure? There are people on the ball busters that are going to jail. Bernie Madoff went to jail. Bernie Madoff had a PPM, right? So, but if you're committing fraud, intentional fraud, and you're defrauding your investors on purpose, then that's the fastest way for you to end up in jail.
But if you lose money unintentionally, you're just a bad operator, you got greedy, which to me, that's why a lot of these guys lost money. They just got greedy.
Yeah.
They lost their fundamentals. They weren't buying right. They were placing it off of future earnings and more rent growth, more appreciation, and they were living off of fees. A lot of them were living off of fees. And they lost all those guys' money. They're not on the hook, though.
No, so
illegally.
Yeah, so we talked about this off camera, that the reason so many people were making a ton of money wasn't because they were any good at what they were doing. They weren't great operators. They just had what we call rate cap compression, which means the prices of the real estate was going up. So you could have been the worst operator in the world. You could have missed all your pro forma. You could have gone from, you were trying to get from 70 to 90% occupancy. You could have gone from 70 to 72. Your rents, you couldn't raise rent. It didn't matter because the price of the real estate went up so much that you look like a king. Now when that stops, that's problematic. Right now you're getting cap rates going up. So now all the operators need to actually operate, and that's part of the problem they're having.
But real skill.
But there's two legal principles here. One is the raising of the capital, which is what I do. And as long as we disclose everything to the investors on the front end when they give you the money, you're good. So that's why I exist, is to make sure you're covered on the front end. That's what the PPM is for, the disclosure document. So even if the deal goes south, from a security standpoint, as long as we disclosed everything and let investors know, we're good. Now, once you acquire the property and start operating it, now you've got to act as what we call a reasonable, prudent operator under the circumstance. So if you screw that up, you could be on the hook for negligence or mismanagement or all of this other stuff that you could do. That's not a securities problem. That's just a business problem. Like you've got an obligation. You have a fiduciary responsibilities to your investor. You have to act like a reasonable, prudent manager would under the circumstances. So if the standard is here and you came below that and there was damages, loss of money, you could be on the hook for that breach of duty.
It was in the PPM that
Yeah, so you're good on the security. You're not going to get nailed for securities fraud or securities violations, but you could get sued for.
Personally.
Personally, that's a different discussion. But you can get sued for just mismanaging, right? To your point.
Even though it's in there, hey, this is risky.
Yeah, even if it's risky because you're disclosing all the risks. If you make a terrible decision, like, hey, if I say, look, Chris, you should have done this, a reasonable manager would have done this.
Yeah.
We would have sold this thing 2 years ago. We would have refinanced, and you didn't. And because of that mistake you made, you were negligent, you fell below the standard, we lost money. You're going to get nailed for that. Breach of contract, breach of fiduciary duty, breach of this, breach of that. You're not going to get nailed for securities fraud or for securities violation.
Gotcha. So when is it time for somebody
to do the jump?
Yeah.
Yeah.
To go from
It's
syndication.
so what I tell people is that, I mean, if everybody could raise a fund, it's great, right? You get the money in the bank, and now you're flush with cash, and you go out shopping, right? And in fact, you probably get some good deals because you can close in pretty fast. You can show the seller that most of these guys are raising capital, but you've eliminated the risk of I can't raise the money's in my bank. I just need to do due diligence, and I can close, right? And you can get bulk discounts. You can buy it all cash and then refund. There's a lot of things you can do. So ideally, it'd be great to do a fund every time. The challenge is it is harder to raise money for a fund. Because think about it, when you do a project-specific deal, the investor's looking at whatever your plan, right? They're looking at your underwriting. They can challenge your assumptions. They go, there's no way this guy's going to raise rents by this, or there's no, like whatever, and I can adjust that number, and I can see what you're doing. I can see where you're buying. Maybe I like the marketplace, I don't. I can see the lending product. I mean, I can see it, right? With a fund, it's a blind fund. Like, I'm investing in you. Like, I know Chris, I trust Chris, but I don't see anything. I don't approve anything. He just tells me I'm going to go buy a bunch of mobile home. Like Brandon. Brandon's a great, I always give Brandon Trinity the example because he's in the mobile home space. And because he's got an audience, he literally, if you look at his business plan, it basically says, we're going to go buy mobile home parks in the United States. That's basically what the business plan says. Right now, the rest of us probably can't do that. We're going to be like in this market, the size, and the condition, and all these other things. But he's got that audience. He's got that people who know, like, and trust him. But so you give that fund criteria. But it's much harder because the investor has nothing to go off other than knowing, liking, and trusting that you can deliver on the deal.
Now, there's two types of funds here. There's a debt fund, and then there's an equity fund.
Yeah.
Talk about the differences in similarities.
So the debt fund, in an equity fund, which is most of the ones we do, is you raise the capital and then you're actually buying the asset. So your fund usually owns 100% of the deal, but maybe it owns a percentage, but it owns equity in the underlying property. With a debt fund, you're basically lending money. So you raise the money into your fund, but instead of owning equity, you're just lending it. Like I could lend money to Chris. So I create my fund. Chris needs some money. My fund lends you money at whatever 12% interest rate or 10% interest rate, secured or unsecured. It's just I act like a bank, right? So I don't get any of the equity, which means I don't get any of the depreciation, all those tax benefits.
Just prefs.
But I get pref. I'm number one assuming I'm in first position. I'm the first one who gets paid if something goes wrong, right? Because it goes, the debt gets first, then sometimes there's a second loan, then there's a preferred side, and then there's the common.
And for the audience that's listening, because there's going to be some younger entrepreneurs who understand what a pref is.
Yeah, it's a preferred. So a pref is a preferred return. I'll tell you what it's not. It's not a guaranteed return. It's just a preferred return, meaning you're going to get 100% of the capital or the returns until you reach that pref. So if somebody has like an 8% pref. Let's just say it's just me. I put in 100 grand. I've got an 8% pref. That means it's $8,000. I'm going to get all the cash flow comes to me until I hit my 8,000, and then after that, it's going to get split however we decide. So it's not a guarantee because if the project just spits off $2,000, I'll get all of it. I'll get the 2,000, but I just made 2%.
Yeah.
Right. And so usually that gets made up the following year, and so next year you owe me the 8%. Plus the 6% you owed me from last year, and so there's a catch-up provision there.
Whereas in equity, they're not getting a prep, but when they sell or cash flow gets distributed, it goes to your
you get your
equity.
Like if I put in 100 grand and I own 1%, then I'm going to get that 1% profit on the back end.
Yeah. To me, when I looked at setting up a fund, I was like, I don't want to do a debt fund. I want to do an equity fund because it seemed safer because I'm not having to pay a prep. I can just go and write checks for assets, cash, and then. If you're writing for what I'm looking to do, and I want to get with you here soon about starting a fund, because I'm a good operator. I know how to find deals.
Yep.
People trust me. I've got to try. The first $20 million in my portfolio, I did with my own money, finding my own deals. So I have a proven track record. I just get, I would get nervous raising, and right now in this environment, it's probably super hard to raise.
It's harder for sure.
It's been harder for me to raise money recently since everything's pulled back. But if somebody like me was wanting to do that, how would you structure something like this? If I wanted to do
what I would do for you if you wanted the debt thing because you've got the experience, what you could do is you could create your fund. Investors would come in. So let's say you raised, I'm making up $5 million, right? So you would raise $5 million into your fund for the sole purpose for that fund to lend your companies, Rood Enterprises or whatever, money for your deals at a predetermined interest rate, 12%, 10%. So it's like you're just basically raising like your own bank, right? Instead of having to go traditional financing, you're going to create your own bank, fund it with investor money, and then you're going to borrow from that fund if that's the way you want to do
okay,
it.
you said pay them a prep. Do I have to pay them a prep, or they just get equity?
In that scenario,
that's
a debt fund. So in that scenario, the fund is loaning you money, so it's a loan. So you've got to pay back the loan at interest only on the debt fund. On the equity fund, then you would manage that fund and you would go buy properties.
That's what I want to do. I want an equity fund where you give me the money, let me operate. Let me operate.
And so you're just going to get. And so if there's the nice thing about an equity fund is that if there's no profits or no cash flow, then there's no distributions. Like if one particular, or you feel like, hey, it's getting a little tight, let's pause distributions because I want to get my reserves up, or we're gonna have to fix the roof pretty soon. So let's you have that control. You're not obligated to give them anything during the thing. You're not getting anything either, right? So it's like you're splitting. But whatever's available to distribute, investors get 80% or 70%. You'll get 20 or 30%. But if there's no money to distribute, they're not getting anything. And so it's the investors get the depreciation on that one too, which is a big thing for them, especially if it's bonus depreciation. That's a big selling point that you guys can definitely attack, because if there's 100% bonus depreciation, especially in multifamily, you can get a scenario where somebody invests 100 grand and they get sometimes 100%, like 100 grand gets deducted from their taxes, right? So that's already saving them, depending on the tax bracket, 30, 40 grand, right off the bat, which does not work, doesn't exist in a debt fund.
This is great, man. This is like a master's degree to my audience on private money. If somebody's 25, 26 years old and become an aspiring real estate investor. This is some valuable information, because you got to learn this, guys. You guys that follow me and you see all the stuff I'm doing, I can't do this without private money, right? And there's layers to this, right? You start off with maybe a joint venture, then eventually do a syndication, and I'm eventually going to work myself here to a fund. But you do it on a gradient scale. You don't go straight to not knowing how to do anything. Just because you got 2 million followers on Instagram and you start a fund and now you're broke and you're going to jail and you're on Baller Busters. That's not how you do it, right? So understand there's layers to this. There's levels and there's understandings. But man, this was great, by the way. I definitely want to get hooked up with you soon.
Yeah, sure.
And if some of my audience here that's watching, where can they follow you? Where can they get hooked up with you if they want to do something with you?
Yeah, if they want to reach out, just go to askmauricio.com and they'll get a hold of me. And I'm on pretty much every social media platform, but LinkedIn's kind of my favorite. So if you're LinkedIn, if it's a younger audience, it's probably Instagram. I'm definitely on Instagram as well, so look me up. I'm not that hard to find.
Great, awesome. Well, look, go follow him, go subscribe if you need help with it. You do mentoring coaching too.
Yeah. So I started a mentorship program. So it's a very inexpensive way to have weekly calls with me, and you could ask your specific questions. So if you've got a question like, hey, I've got a joint venture, here's how I'm thinking about structuring. Is this a security or not? You can come on these calls, show me what you got, and we'll go through that. If you've got social media posts that you're not quite sure if those are good or not, you can come on the call, show me the social media posts. If you got a website, we didn't even talk about websites, but your website's blasted to the world. So you want to make sure if you're doing a 506B where you're not allowed to advertise, make sure your website's clean, because you can't be advertising on your website. So we do a lot of those types of reviews, but primarily come on, ask a specific question, and we do them once a week, and it's just a good way to do that. So just reach out to askmauricio.com on that.
Awesome, guys. And if you like this episode, please like, subscribe. If you don't like the episode and you just think I'm a dipshit, you can make a comment, help the algorithms. And make sure you share this to somebody who needs to hear it. And if you want to come out to an Allies Mastermind, these are the kind of guests that we bring on, where we talk about everything business, real estate, entrepreneurship, to help you guys skill up in your business. I'll see you guys on the next Beyond the Skills podcast. Peace.